So there's been undoubtedly a ton of drama in the financial sector, both in the US and globally. This is following the collapse of Silicon Valley Bank, which, by the way, is actually one of the largest banks to ever collapse in US history. So this is certainly a big deal. But it does seem like the latest opinions here is that this is not a crisis, but rather it's just going to ultimately slow down growth in the economy. So that's good because the last thing we want, the big fear associated with all this, is that it's not limited to just these handful of banks and it's going to spread across all sectors of the economy like it did back in 2008. And even Jerome Powell, earlier this month when he raised rates, he spoke on this issue and he wasn't that concerned about a wider contagion. And he almost gave it a positive spin at the end, saying that this is going to help the Fed do their job of restricting financial conditions and ultimately squashing inflation.
So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever.
But one major impact of all this is it's forcing people to reevaluate the risk associated with where they're keeping their money. Deposits held by small US banks dropped by a record 119 billion after the collapse of Silicon Valley Bank. One of the major reasons why Silicon Valley Bank collapsed was credit risk. They had exposure to all of these long-term bonds that were yielding about 1 to 2%. And those bonds in this current market, where you can get a bond yielding 5%, are just worth a lot less, contributing massively to the financial chaos that company faced. And any other financial institution that has similar exposures are being reevaluated by investors. Even otherwise quality names like Schwab here experienced a massive sell-off during this event. And this is also extending to funds like Jepi because of their more complicated financial derivatives that they invest in. So ELNs are a pretty complicated way to invest. They are subject to things like counterparty risk. And I really like the first comment here saying that, in my opinion, you should always be concerned about the latest opaque Wall Street structured product. You can't just decouple risk from reward, and Jepi has a lot of reward. So considering the current market backdrop, I think it's worth revisiting Jepi, specifically the risk associated with it, and see whether or not it's still worth it. Of course, this is not personalized financial advice, and always do your own due diligence. So let's begin with the facts here. This is straight from the official website of Jepi, talking about the risk associated with investing in this fund. The first point here is the price of equities may fluctuate rapidly or unexpectedly due to factors affecting individual companies as well as changes in economic or political conditions. So this point here is referencing that the value of your investment, of course, can fluctuate up and down with the rest of the market. This paragraph, however, has to do with the ELNs, which is in specific the part of Jepi which is coming under more intense scrutiny. So it says here, investing in equity-linked notes, ELNs, are subject to liquidity risk, which may make ELNs difficult to sell and value. Lack of liquidity may also cause the value of the ELN to decline. Since ELNs are in note form, they are subject to certain debt security risk, such as credit or counterparty risk. So the first part of this about liquidity is a legit concern. If you can't sell the equity-linked note, then you have to lower its value. But I think the risk that's most concerning at the current moment is the counterparty risk, because the ELNs are in a note form and are subject to certain debt security risk. So focusing on the ELNs, here's a bit more official information about this derivative. So in order to generate income, the fund may invest up to 20% of the net assets in these equity-linked notes. These are issued by counterparties, including banks, broker-dealers that are affiliates, and are designed to offer a return linked to the underlying instruments within the ELN. These ELNs are specifically designed to combine the economic characteristics of the S&P 500 index with written call options in a single note form and are not traded on an exchange. As a quick side note, we should all be aware of how call options also work. because they have a specific kind of risk associated with them as well. So call options limit the upside potential of your investments by putting a cap on their price. That cap is the strike price of the call option. So for example, if an asset is trading at $100 per share, you sell a call option on it with a strike price of $105. You collect a premium for selling that call option, but during the lifespan of that call option, if the price of the asset goes to say $110, you are forced to sell it to the owner of the contract for that previously agreed upon $105. Coming back to this wall of text, the ELNs owned by the fund are structured to use a covered call strategy and have short call positions enabled within them. When the fund purchases the ELNs from the issuing counterparty, the fund is entitled to the premium generated by the short call position within the ELN. Therefore, the ELN provide recurring cash flow to the fund based on the premiums received from selling call options and are an important source of the fund's return. Then, as we discussed over here, when the fund sells call options within an ELN, it receives a premium but limits its opportunity to profit from an increase in the market value. And this right here is the actual equity-linked note position in Jepi as of September 30th, 2022. They have 16.7% of the net asset value in these equity-linked notes. They are linked to the S&P 500. This is the participation rate, and these names over here are the issuers of the ELN, and it's the source of the counterparty risk associated with equity-linked notes. Because if one of these names go bankrupt, they're not going to, of course, be able to pay their debts, and you might lose your investment in that ELN. Now, luckily, Jepi is managed by JP Morgan, a pretty respectable, experienced name in the financial sector. And to help mitigate that risk, that is why we see this spread across many different institutions. And of course, the ELNs are only a portion of the overall portfolio itself. But no matter how competent or excellent the management of Jepi may or may not be, this risk is always going to be there. And this data right here kind of proves that, because back in December of 2021, one of the issuers of the ELNs was Credit Suisse. And as I'm sure you guys are aware, this is one of the companies that recently collapsed. And in mid-March of this year, UBS purchased them for $3 billion. So it's vital to remember, and this recent banking fiasco has helped to remind us of this, but you have to understand what you're investing in and the risk associated with it. And it is true that due to the added complexity of Jepi with the equity-linked notes, a fund like this just inherently has more risk associated with it than, say, a broad market index like the S&P 500. But for you, of course, the added risk and the characteristics of Jepi, like the high dividend yield, might be completely worth it. And that's just something you have to decide for yourself. Now, I know a lot of you guys watching this video invest in Jepi, so definitely leave a comment before you leave, letting us know your thoughts, your current thoughts on Jepi, what you plan on doing, and just your general outlook on the market right now. If you want my opinion, I think Jepi will be fine, even if one of their holders of their ELNs does have some kind of financial difficulty. It shouldn't tank the entire portfolio. But of course, that's just my opinion, not financial advice. If you're still watching and enjoyed, I appreciate a like before you go, subscribe, and I'll see you guys in the next one.